Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial professionals John and Michael from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. Today, they have brought in a special guest, and that is Paul Dietrich. Paul Dietrich is CEO and Chief Investment Officer of Fairfax Global Markets, LLC. Fairfax currently manages investments for private investors, retirement funds, and private institutions throughout the United States. He is an international corporate attorney and was formerly associated with two Washington, D.C. law firms, Squire Sanders and Dempsey, which is now Squire, Patton, Boggs, and Jones Day. He has been an advisor on privatization and economic development issues to the World Bank, as well as several governments in Asia, Eastern Europe, and the former Soviet Union. Good morning, gentlemen. How are you?
Good morning, Eric. Good morning, Eric.
Great.
Hello, Paul. How are you?
Great.
Wonderful. Thank you so much for being here. Michael and John, why did you bring Paul in today?
Well, we brought Paul in. Paul's actually the chief economic analyst that we have at Copper Beech, and as we've talked about on some prior podcasts, we are outsourced to a lot of specialists, and especially when you look at the economic world that we live in today, we need experts in that world, and Paul is a foremost expert in that. And so we brought him in today really because to talk about two recent economic developments that we think are pretty important for our listeners to really get ahead on. So that's really why we brought him in today, is to really give us a sort of a state of the markets and state of the economy, so to speak.
Awesome. I'm here to learn. Teach me.
So Paul, there's a lot going on here, which I'm sure you will get into. But most recently, we're seeing a couple things we're starting to hear some rumblings about recession on the horizon. We're in a 10-year bull run now, and I think, at least when we talk with our clients, that's really foremost in their mind, is sort of trying to predict when the recession is going to happen, because we know that it's going to happen at some point. We can't have this 10-year bull run going on forever. So what are you seeing in that side of the world that maybe put on your crystal ball a little bit and figure out where we're headed?
Yes. Well, there's no question that we will have a recession at some point. I mean, economists look at recessions as kind of, it's like the day, the night following day. It's part of the cycle. It's a cleansing of the economy. And so it's actually a good thing, except that when you watch your money going away in a down market, you don't think it's a good idea, right. But in the broader scheme of things, it actually is. And there's no question we're now in our 11th year of the longest economic boom in the history of the United States. And all economists can see a slowing down of the economy. And one of the things that I've been doing for over 20 years now is watching leading economic indicators in the United States. Those are the indicators that kind of go down 8 to 18 months before you start noticing something's happening in the economy. And this is what I talk a lot about on CNBC and Fox Business News. And what we're seeing now, last year we had 3.1% growth. The GDP figures just came out this week, and it looks like we're going to have about 2.5% growth this year in 2019, and probably 2% growth next year. You have to put all this into context. If you remember, during the last 4 years of the Obama administration, the average growth was about 2.2%, and we still had a bull market in the United States. But there's no question that a recession is coming. One of the things that people learn in Economics 101 is that over the long term, the U.S. stock market always follows the directional trend of the underlying U.S. economy. If the U.S. economy is growing and expanding in the long term, the U.S. stock market will go up. And if the U.S. economy is plateauing or going sideways, the U.S. stock market in the long term will go sideways. And if the U.S. economy is declining, the stock market in the long term will decline with it. Now, in the short term, it does all sorts of crazy things. It reacts to President Trump's tweets. It reacts to, what the North Koreans are doing. I can assure you, whatever happens in Brexit, when that comes at the end of October, the stock market will react. But I try to, and I think all investors ought to try to look at all that stuff as noise. Even to some degree, the trade war with China, although that's having some real economic impact, not as much as you would think given the coverage on news shows, but it still has some impact. But most of this stuff is just noise, and in the long run, you just have to look at the underlying economy to know where the stock market is going. It is starting to slow, and the big question is when is it going to start? And I've kind of compare all the leading economic indicators, and you can't time the market, but you can know generally when the next recession is coming just by looking at these leading economic indicators. Now, for example, when I look at every month, I look at UPS and Federal Express and the railroads and ocean freight shipments. And if shipping starts to decline year over year, it means companies are buying less, and that's not good. And when manufacturing starts to go from 3 factory shifts to 2 shifts, orders are slowing. And when companies begin lowering inventory, they expect sales decline. And so these are the indicators that start dropping before investors start seeing official sales and earnings and manufacturing declines. And that's why they're called leading U.S. economic indicators. And so I analyze all of these, and if you look at them right now, there are about 28 of them. There are 4 that are going sideways. There are 2 that are in negative territory, and I'll tell you what those are in a second. But the rest of the economy is doing really well. I mean, GDP is growing and expanding. Unemployment's going down at a 50-year low. Wages are going up. Basically, the economy is doing quite well. And we're only seeing a few things that are starting to go sideways, or a few negative things. And I look the Cass Freight Index, which looks at shipping, because that's a really important one. It's been going down for about 5 or 6 months now, but there are a lot of people who think that could change because shipping has gone down because of the tariffs and the trade war with China. There's no question that that's been affected. So we're trying to figure out whether this is just a short-term thing over the last 6 months and it'll go back up when there's a trade agreement. But the inverted yield curve, that's something you've probably been hearing about on the TV.
Right.
It's something you need to pay attention to. Since the 1950s, 100% of the time when it inverts and it becomes officially a recession signal, it means we're going to have a recession. And I'll tell you how it works. And they never tell you this on television.
I was going to ask, Paul, if you could,
thanks for that.
if you could explain, because that is something that I know our clients have heard when they listen to TV or they read, the Wall Street Journal. They hear about inverted yield curves, and they aren't quite sure what that means. So
no, it's one of these things where your eyes roll over, because nobody knows what it is. But the reason the inverted yield curve matters is that if short-term rates, interest rates, climb higher than long-term rates, that's what's known as an inversion, this kills lending by banks and financial institutions, and lending becomes unprofitable and can implode. And so that's why it matters. However, most academics believe for this to become a true recession signal, the yield must stay inverted for at least 2 to 3 months before it can credibly be said to be sending a clear economic recession signal. Now, the 10-year versus the 3-month yield, which is what the government uses to kind of determine whether there's a recession, that actually has just recently it's stayed down for 3 months, because if it just inverts for a day and goes back up again, nobody pays any attention to it. But it has now triggered. I think at August 23rd, it actually triggered the recession signal. But what this means is, I wouldn't get too panicked, is that this is the earliest of the early warning signals. Historically, and again, going back to World War II, this gives us a signal 15 to 18 months, usually 17 to 18, but one time it was 15. That means we won't have a recession for about 17, 18 months from now, which means it will be the last couple months of next year or the beginning of 2021. And you have to remember, the stock market, if you look back at all of the previous recessions, in most cases, the stock market reaches record highs about 3 or 4 months before we go into recession. So you don't want to get out of the market now when you hear that there's a recession signal for 18 months from now, because you're going to miss a lot of profits this year and next year. Presidential election years historically have been, really good years for the stock market, and it's usually because whoever is president, and I think it's particularly true of our current president, is that he is going to use every single tool at his disposal to win this election. I mean, he now has enough people that he's appointed to the Federal Reserve. I think you're going to see rate cuts probably in late September. You're going to see more rate cuts next year. He's going to use every tool that he has available to him to make sure that this economy is booming before the election.
Yeah, he's been tough on the Fed. He's been hammering for the last couple of months.
Yeah, and he's gotten to do what he wants, and now that he's appointed a few new people, he's going to get that stuff through. So next year, they're going to be goosing the economy, and I use that term as an economic term of art, and he's going to make sure. And so I think the stock market's going to be good this year. I think it's going to be really good next year, and after the election, Katie bar the door, because we're probably going to have a recession shortly thereafter. Normally, I would say that a recession, this next recession will be a mild recession. We've had the 2001-2002 recession, the S&P 500 went down peak to trough during that recession, about 18 months, went down 49%. And then in the last recession, it went down 57% during the 18 months or so of the recession. I think this one will probably be about 35%. But I have a warning for people. In 2008 and 2009, during the last recession, we really didn't have something that we have now because of technology. We don't have algorithmic computer trading. That's computer trading where there's no human being involved in the trading. And at some point, you got 52% on a daily basis of trades are made by these computers, and it's causing massive volatility. So what you see is if you see any little selling in the market on a given day because of a tweet of the president's or something else happening in the world, all of a sudden the market just gyrates down. And then about 3 or 4 o'clock in the afternoon, all the exchange-traded funds have to sell in order to match their fund with the index that they're tracking. That drives down the market. And then the last 15, 20 minutes of the day, those algorithmic computer trading, they even drive it down further. So we could see, normally I would say we're going to have about a 35% drop in the next recession in the S&P 500. But because of this crazy trading that artificially drives the volatility down when the market's going down, we could see 50% drop in the S&P 500.
You're setting your curveball real quickly here. Mm-hmm. But as a strategist, if you know, and you're looking at this trend over the next 18 months to 2 years on the cycle of getting into this recessionary piece, should clients be looking at other asset classes, repositioning their assets, hold cash to buy into the down market? What would you typically recommend a client to consider in this time frame, or just hold on and not do anything?
No, that's not the answer, holding on and not do anything. Most people, they spend all their lives, building up money for their retirement, and then to watch, as we saw in 2001 and 2002, the market go down 49%, and then in 2008 and 2009 go down 57%. Most people, they know it's going to go up again eventually. But I always tell my clients that the best money they'll ever make is the money they don't lose in one of these recessions. And I'll tell you why. If you buy a stock for $100 and it drops 50%, that means it's $50. But to go from $50 back to break even again at $100, that's 100% gain. And I don't care whether you're Warren Buffett. You can't do that quickly or easily without taking a lot of risk. And for most people, in the last recession, it took them 5.5 years to get back to break even. That means they weren't making any money just to get back to where they were in 2007. 5.5 years, and that's just too long. And I agree with people who say you can't time the market. I mean, if you can figure out when President Trump is going to tweet something, you're a better man or woman than I am, because I don't know how to figure that out or what he's going to do. But you can time the underlying economy because it runs, we're now in the 11th year of this cycle. It's been an up cycle. And you can watch these leading economic indicators, and they all start going sideways first. And then, majority of them, when they start declining, these are leading economic indicators. You can usually get out of the market and reposition. In 2000, in late 2000, I went on the Financial News Network, which is now called CNBC, but at that time it was Financial News Network, and I was talking about these leading economic indicators. And I basically said I was repositioning my clients into safer investments, and I moved most of them into bonds during that period of time, and bonds were paying something. The market went down 49% during that recession, but my clients went up 7%. And then in 2008 and 2009, just before Lehman Brothers collapsed, I was on both CNBC and Fox Business News saying, these economic indicators are starting to decline. Now's the time to start rethinking your portfolios. And then Lehman Brothers collapsed. I had already started moving clients out, but we did lose, I believe it was 8%, but that was better than losing 57%. We recovered in a few months when the market went back up again, whereas it took 5.5 years for most people to get back to break even. And I was also worried about at the time. I was worried about the banking system, as everybody I think was, and so I moved a lot of my clients into gold, just because I thought that was the safest thing to be in. I was only in it for about 6 months, and then when I saw that banks were going to collapse, I moved back into repositioning. But that's the time to do it. Also, that's and you want to be in liquid things so that when the market actually does hit a bottom and starts to come back, and again, you can see that when the economic indicators, they started to turn in March of 2009, and really by April and May, you saw major turnarounds in these economic indicators, and things started going up, and that's the time to get back in, but you would be buying at the bottom of the market then.
Yeah, Paul, and we talked a while back about that when you try to shift these portfolios that are in a taxable account, we have some tax exposure when you sell out and go to another position, whether it's bonds or cash or gold. Well, how do you handle the tax issue around changing these portfolios? I know your principals say you'll still do better than staying in the market, but how do you explain that to a client when they say, "Hey, I just got a tax hit of X on my portfolio because I made this move," because they can't really see that future yet? How do you walk them through that?
I've been managing money for well over 20 years now, and I have gone through this over and over and over again with clients. Is that I've, as an attorney too, I've always think it's a mistake to let the tax situation, because you're talking about capital gains taxes, which nowadays aren't all that high, wag the investment dog, and it keeps people in bad investments. I mean, think of everything that's changed in the world. You see companies like Sears, which those were great companies at one time, and now it's people were telling me back in the recession that they didn't want to sell out because they didn't want to pay taxes. Well, when the market goes down 57%, and you could have gotten out paying a 15% capital gains taxes, I mean, you don't have to be much of a mathematician to realize that you made a real mistake.
Right. Yep. Yeah. It's a challenge for us because we, as a family office for our families, we try to manage all that tax exposure to how they build their wealth and trusts or whatever it might be. So it's always a challenge for us to get in that position of, I know we're not timing the market, but if you read these indicators based on your input here, I want to make sure the listeners understand that there's other pieces of the pie they got to watch as they do these maneuvers, if they choose to do that. There's going to be some
tax loss change. All the tax loss management. There are a whole bunch of things that you can make sense, but in the end, if you're not paying taxes, you're not making any money.
So our guidance would be go back to your tax advisors and make sure they're in the loop as you make these decisions, because I think our clients have to understand that their CPA is going to be a very important part of this discussion to look at the losses and generate some offsets with loss harvesting, et cetera. So that's a critical piece to this. Okay.
Yeah, and one of the things I talk a lot about on television is disruptive technologies. And I mean, we've seen so much of it. What Walmart did to Main Street retailers and what Amazon has done to malls and some real estate investing, and companies like Sears and other retailers, and what Apple did to BlackBerry. I had a client who had some of the biggest ownership positions in BlackBerry, and they just wouldn't get out. And the company nearly collapsed after a few years of Apple iPhones, and they didn't do it because of the taxes. And everything I've seen over 20 years is that you've got to pay attention, taxes, but you also have to pay attention to the underlying investments, and you have to pay attention to the underlying direction of the economy.
Yeah, that's a great point.
Now, as far as the recession for us here in the United States, I know we're having a lot of pressure globally as we speak. They're in a lot worse position than we are as a country. How will that impact the next 18, 24 months as we slide into a potential recession here in the United States?
Well, I believe that Europe will probably go into recession first. We'll probably go into recession second. Emerging markets might go into recession, but that won't affect much of the U.S. market. I don't think Asia, it'll slow down, but it won't technically go into a recession. I mean, China's still growing at 5-6%, which is really good, but that's much less than they have been. But they probably won't actually go into negative growth. And so it will have some effect. But, if we get a trade agreement, eventually we will. There's no question about it. Eventually we will. I think that will help the U.S. because we do more trading with Asia than we do with Europe.
You mentioned Brexit a little earlier, Paul, and that being more noise than anything else. Can you elaborate a little bit on? Because I mean that is something that obviously when it occurred was a major news item, and the stock market did dip pretty substantially, and then it obviously came back pretty substantially. But elaborate on why that isn't as big of a major issue for the world than maybe the pundits say it is.
Yeah, well, one of the first times after Brexit passed, I think the market went down 18%. It was a serious correction, and then about 2 weeks later, everyone realized that nothing was going to change for a couple of years, which it hasn't, and that it had no effect on the U.S. economy. Everything that we do with trading with Great Britain will be exactly the same. Everything we do with trading with Germany and France afterwards will be exactly the same. However, it is going to create, if they do no deal Brexit, meaning that they can't come to an agreement, Britain can't come to an agreement with the European Union, it's going to be a mess for Britain for probably several months until they get new customs set up. There will be shipping problems. But I don't think it's going to be near as bad as a lot of people think. But even if it is, it's just going to be it's going to be a mess for their economy, but it's not going to have any effect whatsoever on the U.S. economy.
Yeah, one of the other issues that pops up with our families when we speak to them in general terms, it pops up occasionally on the political scene. Obviously, we're going to an election next year. And there's always a question, well, if the Democrats get in, what does that really mean? If Donald Trump stays in office, what does that mean? What is your perspective on the political sides of things, and will that impact the markets? I know typically it doesn't for long periods of time, but I'd like to get your insight into that.
Just as I think the economy has, there are things I like about Trump's policies. There are loads of things about him and the way he does business that it makes it hard to like him. But with the tax cuts, that's definitely boosted the economy. The Obama administration, I think any reasonable person thinks that they went overboard on regulating business, and it was really stifling business, and particularly small businesses here in the United States. And I think that if the Democrats win the presidency, they'll be reversing, just as President Obama put in all these regulations by fiat, he did it by executive orders. They didn't come through Congress. They weren't thought through particularly well. Trump has reversed most of those, again, by executive order. I think, depending on who wins the Democratic nomination, but especially if it's Sanders or Warren or someone like that, they're going to even go further in regulating the economy. And so that will have, I think, a negative effect on the economy. That's been some of the better things that Trump has done. I'm not crazy about some of his environmental regulations, but in general, he's really taken off a lot of that burden, and some of it was just crazy stuff that was being passed before. So I think all in all, I think there will be a trade agreement eventually, and one of the things that people don't understand, I'm friends with a number of the people on the trade talks who are actually negotiating with the Chinese, is that for a while they were thinking that the Chinese just wanted to get beyond Trump, wait until after the election, and they thought they could get a better deal from Joe Biden or from the Democrats, who's ever the Democratic nominee. And now I'm told as of last week that they've switched on that they understand that the Democratic Party today is not the Democratic Party of Bill Clinton and even Barack Obama, who negotiated the Trans-Pacific Partnership. And both Obama and Clinton were free traders and globalists. And now you're seeing in the progressive wing of the Democratic Party, they are really anti-free trade. The labor unions are their biggest funder, and they're not only the biggest funder for the presidential candidates, but the biggest funders for both the Senate and the House seats. And one of the things that they've done is they basically said, if you want to take our money, you cannot vote for these free trade agreements. And if you look at the deal that President Trump negotiated with the new NAFTA with Mexico and Canada, which is 100 times better than the old NAFTA, and yet it's being blocked by Nancy Pelosi and the Democrats because the unions are opposed to it. And so I think the Chinese have realized that, as difficult as Donald Trump is, and as mercurial as Donald Trump is, he at least believes in free trade, and if they come to an agreement, they know he'll sign it and he'll do it. But I think they're thinking that the Democrats don't want any free trade agreement with the Chinese, and they just as soon keep the tariffs at 25% and make it impossible for people. They're hoping that manufacturers would come back to the United States, and that's what the union position is.
Well, Paul, this is really fascinating, and I know we're running a little bit low on time, but I really would like to continue this conversation in particular because I think it has so many different dynamics and variables to it that I think our listeners would really find value in continuing this conversation. But again, I know we're running out of time, so we'd love to have you back to continue this talk on a future podcast. But we want to thank you for your time. This was great.
Yeah, thank you, Paul.
Thank you.
Guys, this was fantastic. And yes, this podcast is a little long, but I don't think anybody is hitting that stop button because the information.
Good stuff, Paul.
It's good stuff. Good stuff. All right. Thank you guys so much for your time. Paul, I am looking forward to the next podcast. We're bringing you back as a guest. Are you ready to go?
I'm ready to go.
All right. I appreciate it. And thank you all for listening to the Truth About Wealth podcast with John and Michael Parise. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John and Michael come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. And since this is the talk of the town right now, this is the one you want to share. Get it out there. Again, thanks for listening today. For everyone at Copper Beech Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Copper Beech Financial Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
This material is for informational purposes only. Neither APFS nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Securities offered through American Portfolio Financial Services Incorporated, a member of FINRA SIPC. Investment advisory and financial planning services offered through American Portfolio Advisors Incorporated, an SEC-registered investment advisor. Copper Beech is an unaffiliated entity of APFS and APA. Any opinions expressed in this forum are not the opinion or view of American Portfolios Financial Services Incorporated, APFS, or American Portfolios Advisors Incorporated, APA, and have not been reviewed by the firm for completeness or accuracy. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors.